Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Paramount Group Inc. quarterly report. Paramount Group Inc. provides a range of businesses and services including owning Class A office properties, operating high-quality office spaces, managing commercial real estate portfolios, acquiring new office buildings for investment, redeveloping existing office properties to maximize value, providing property management capabilities to attract and retain tenants. Paramount Group Inc.'s stock price increase. A year of growth and success. In the past year, Paramount Group Inc.'s stock price has experienced a significant surge, with a reported 29.3% return over the last year and a 31.7% increase year-to-date as of late October 2025. Several key developments have contributed to this substantial growth. One major factor is the company's successful leasing activity in New York, particularly a notable 16.5-year lease agreement signed with Benish, Friedlander, Coplan and Aronoff LLP for 121,000 square feet at their Midtown Manhattan property. Additionally, strategic partnerships and a rebound in commercial property demand have been viewed as positive indicators for future stability. The company's asset sales and capital management efforts, including the sale of a 45% equity interest in 900 3rd Avenue and a 25% share in One Front Street, San Francisco, have also generated significant net proceeds. Paramount Group's strong revenue growth in 2024, reaching $710.37 million, a 50.61% rise compared to the previous year, has further boosted investor confidence. The company's commitment to sustainability was recognized with its 7th consecutive GRESB 5-star rating on October 22, 2025. Analyst upgrades, such as Morgan Stanley's upgrade from underweight to equal weight, have also contributed to the stock price increase. Overall, these factors have driven considerable stock appreciation, positioning Paramount Group Inc. for continued growth and success in the future. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by increased rental income from office properties due to higher occupancy rates and rental growth. Property sales contributing to revenue growth. Revenue decline is primarily driven by decreased rental revenue, with a 10% decline in total rental revenue and significant decreases in fixed and variable rental revenue. Decrease in fee and other income. Net income and profit margins decline in 2025. The financial performance of a company took a significant hit in 2025. Net income plummeted from $9,688,000 in 2024 to a net loss of $58,758,000 in 2025, marking a staggering 27% decrease. This decline was driven by a 203% increase in net loss for the 3 months ended September 30, 2025. Profit margins also suffered, with NOI margin decreasing by 15.6% and FFO and core FFO declining by 43% and 19%, respectively. The 9-month period saw an even more substantial decline in profit margins, with NOI margin down by 10.3%. These significant decreases in net income and profit margins indicate a challenging year for the company in 2025. The company's financial performance indicates a consistent generation of positive operating cash flow. For the 9 months ending September 30, 2025, the company reported an operating cash flow of $83,040. Although this is lower than the previous year's figure of $176,570 for the same period in 2024, it still signifies a positive trend. This suggests that the company has sufficient liquidity to meet its financial obligations and invest in growth opportunities. The company's debt level and interest expenses have undergone significant changes. A notable increase in debt level is observed on page 35, where it rose by $900 million following the refinancing of 1,301 Avenue of the Americas. This change is further reflected in the interest and debt expense, which increased by $5.8 million from $124 million to $129.9 million on page 49. Additionally, page 53 highlights that the debt level has changed significantly due to refinancing and modifications/extensions of loans. The financial performance of various segments in 2025 revealed some concerning trends. The New York and San Francisco segments were the underperformers, showing a decline in comparison to their respective performances in 2024. These regions struggled to meet expectations, indicating potential issues that need to be addressed for future growth. Management's outlook on company strategy. The company's strategy is to focus on acquiring and redeveloping high-quality Class A office properties in select central business districts of New York City and San Francisco. Despite acknowledging various risks associated with the mergers, management remains confident in their ability to operate effectively despite these uncertainties. They expect adequate liquidity over the next 12 months from existing cash balances and operating cash flow, which will be supplemented by long-term funding through a combination of operating cash flow, third-party capital, mortgage financings, refinancings, and debt/equity issuances. The company has made significant moves in its financial strategy through acquisitions and divestitures. Key highlights include acquisitions. The company has engaged in mergers, as defined on page 31, marking a strategic expansion of its business. Divestitures. In contrast, the company has disposed of currently owned properties, subject to certain exceptions outlined on page 69, indicating a deliberate effort to streamline and optimize its assets. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In the past year, it paid out dividends totaling $25,118,000 to common stockholders. Additionally, the company has implemented two significant share repurchase programs, one with a capacity of $200 million approved in 2019 and another with $15 million of capacity. These initiatives demonstrate the company's commitment to returning value to its shareholders through both cash dividends and strategic share purchases. Concerns surrounding inventory buildup and supply chain disruption. A review of the financial summary reveals potential issues related to inventory buildup and supply chain disruption. Specifically, an inventory buildup or supply chain disruption is noted on page 8, with a significant negative balance of $33,269 under accounts and other receivables and other assets. This suggests that there may be problems in managing inventory levels or disruptions in the supply chain, which could have serious implications for the company's operations and financial health. That concludes the financial summary for Paramount Group Inc. Feel free to comment below, and I will be happy to answer them when possible.